day, everyone, and welcome to another of our CAM communications to you, our clients. I hope you are well, healthy, and safe. And we're looking forward to spending some time with you today again. Over the past couple of weeks, we spoke a lot about economic developments in markets. We've touched a lot on some of the big asset classes, equities and bonds. And today we would like to spend a little bit more time on commodities. Commodities also had a very volatile period, especially something like oil and gold. And we would like to show you how we think about this as part of our strategic thinking, and then how we include this into our portfolios on behalf of our clients. So joining me today is Victor van Reiche. He's one of our equity portfolio managers. A lot of you will know Victor because he's very much involved in managing some of our clients' bespoke portfolios. So he is very often in client meetings as well. And he will share with us some of his insights in terms of the commodity markets. So Victor, welcome, and let's get going.
Good morning, Maarten.
We're going to start. I'm going to start by asking a couple of questions, and then to get your insights in terms of what's happening in these markets. I think over the past quarter we do have, we have seen a lot of volatility in the oil price, and the question is, are we dealing with a demand shock, the fact that the global economy is locked down, or a supply issue where the producers are still producing, and as a result of that we've got an oversupply. So is it a combination of demand and supply, or what are we really seeing in terms of what's playing out in the oil market at the moment?
I think it's a combination of two factors, but it's predominantly a demand issue. I think it might be instructive to give the viewers an oversight of exactly what happened in the oil markets over the first 4 months of the year. So quite a sort of a positive start in January. We saw a number of factors, bullish factors for oil, resolution to the US-China trade tensions, to the cyclical economic recovery, resumption of oil consumption, and Brent was trading at close to $70 per barrel. Then in late January, it became clear that the coronavirus was not contained in China. China went into lockdown, and oil consumption forecasts were dramatically cut. Brent traded close to $60 per barrel at that point. In early March, the wheels really came off for Brent, falling another $10 per barrel as the coronavirus became a global epidemic. Oil consumption continued to fall, and then in addition to that, we saw a supply shock when Russia and Saudi Arabia couldn't agree to further production cuts. By mid-March, Brent was trading at below $35 per barrel as Saudi Arabia went into punishment mode, increasing production significantly. Volume warfare broke out, and oil production was estimated to rise by between 2 and 3 million barrels per day. By late March, the world went into global lockdown. Brent was trading at $25 per barrel. Oil consumption was estimated to fall by 20 to 30 million barrels per day. We saw refineries significantly cut processing capacity as the demand for jet fuel and petrol and diesel continued to fall, and oil storage started to fill up rapidly. By early April, Brent was trading at $30 per barrel. The oil industry was in full crisis. It was all about cash conservation. And we also saw US industry under significant pressure. I think if you look at the next slide, we show EIA global oil production and consumption forecast from the first quarter going forward. And I think based on this slide, it's clear that it's mostly a demand issue. You can see demand has fallen off a cliff. It's estimated to trough around 18 million barrels per day. We've seen a supply response as well, but the reality is that oil markets will probably only go into equilibrium by the third quarter of 2020. We see significant stock build as well, over 10 million barrels per day. And then as we enter the third and fourth quarter of 2020, we see gradual inventory drawdowns starting to play out. On the next slide, we show oil demand estimates. Again, this is from the EIA, showing you the demand profile. So we've seen a significant collapse in demand. The expectation is for a sort of a recovery in the third and fourth quarter as the world exits this global lockdown. The fall in demand is expected to be around 8 million barrels per day. Most of that comes from OECD countries, constituting for the bulk of that collapse. And the expectation is for oil demand to only normalize by 2021 in the first quarter. To put the sort of historic demand destruction in perspective, this is work from the International Energy Agency and BP. The expectation is for a collapse of 9 million barrels per day in 2020. And you can see this is completely unprecedented. It effectively wipes out demand growth over the past 10 years. And I think clearly it demonstrates that we're dealing with a demand issue here. Just on the supply side, the expectation is for a reduction of 5 million barrels, just over 5 million barrels per day in 2020. The bulk of that comes from OPEC countries, as you would expect. Non-OPEC, being the US, Russia, and Canada, accounts for around 2.4 million barrels per day. And again, if you look at the supply profile, the 5 million barrels per day reflected here on the black line, we see a gradual recovery on the production side, but only getting back to pre-COVID-19 production levels by the end of 2021.
Okay, so obviously it's much more demand issue than a supply issue. So recently, oil traded negative, and maybe just explain to us, from an economics perspective. In Economics 101, they taught us that when demand rise up, price will go down, but it will go down to zero and not into a negative. So did oil actually trade at a negative price, or what happened recently in terms of that price action?
So the next slide basically summarizes what happened. So I think it was really a technicality. It was the May futures contract that traded deeply negative. So not really the underlying commodity, more the May futures contract. I think it was a unique confluence of events that saw the May futures contract trade deeply negative. Just to give a bit of background, the futures contract, futures markets exist as a way of providing both producers and consumers of oil a way to hedge the exposure. In the US WTI, futures contracts settle physically, meaning that the owner of the futures contract has to take physical delivery of that oil. Most of the oil is stored in Cushing in Oklahoma, and I think with the macro backdrop playing out for as we've pointed out, you saw a complete collapse in demand, not a sufficient supply reaction initially. We saw global oil storage filling up very quickly, and the same happened in Oklahoma, meaning that the cost of storage started to rise rapidly, and making it almost impossible for traders and speculators to take physical delivery of oil. In addition to that, with the sort of collapse, macro collapse in oil, we saw oil flip from backwardation, and what that means is that further out on the futures curve, your prices are trading below spot, switched into contango, meaning an upward sloping futures curve. And because of the June contract still trading at $20 per barrel at that stage, it almost made it impossible for traders to roll, or speculators to roll their futures contract into June. So effectively, traders and speculators were left in an impossible situation. They couldn't take physical delivery of oil because of high storage costs and high cancellation fees. And they could also not roll into the June contract because of the spread that opened up. And that effectively left them in no other position but to sell the May contract. And that's why we saw the May futures contract trade deeply negative.
Okay, so it's almost as simple as, if you can't take delivery of the physical oil because you're a trader sitting in an apartment in New York, your only option was to almost sell it at a negative. In other words, almost paying someone to rather take it and then take delivery. And I guess that's also a function of the oversupply we're seeing at the moment, given the lack of demand. But these developments, Victor, must have quite a significant impact on the energy sector all around the world. But we know that the energy sector in the US been growing quite rapidly. There's a lot of high yielding companies, meaning that there's a lot of funding going into that space. The whole shale revolution. What is your take in terms of the impact on that, given the current dynamics for the US energy sector?
So on the next slide, I show where US shale sits relative to the global cost curve. So North American tight liquids could represent US shale. I think a couple of important points to make. Undoubtedly, shale producers are under immense pressure with WTI trading around $30 per barrel. The second point to make is that over time we've seen a significant fall in the break-evens. As your cumulative output of wells has increased, we've seen a commensurate fall in break-evens, and that has meant that US shale has fallen from around $68 per barrel in 2015 to around $46 today. But there has been a significant reduction in the break-even. We don't think the US shale industry disappears. US bankruptcy laws means that assets are recycled, not retired, meaning that we think that big multinational integrated oil companies will acquire these assets cheaply, lowering their own cost base. We think there is a painful restructuring at the head of the US shale industry, but we don't think that it will disappear. If you look at the North American tight liquid cost curve positioning, maybe in one level deeper, you can see under what stress US shale is currently, with WTI trading around $30 per barrel, meaning that over 90% of producers are cash burning. The graph here shows you the different basin break-evens, and it's a bit small to see here, but instructively, a lot of these basins are already being operated by big multinational oil integrated players. So we think that trend continues. And then the next slide shows you the Baker Hughes oil rig count, and we can see under what significant duress US shale is. We've seen a collapse from a cyclical high in November 2018 of just under 890 oil rigs, and that number falling significantly to below 300 now, and actually taking out the 2016 low when oil markets collapsed. So I think to conclude, there's no doubt that US shale is under immense pressure, but we don't think it goes away. We think that unit economics dictate that break-evens will continue to fall, and we also think that a number of the multinational oil companies will acquire these assets cheaply.
Yeah, so just as a side note, maybe for our clients, this will obviously also contribute, and already did, to the unemployment numbers that we've seen in the States to some extent. Given where we are at the moment, Victor, and us also sitting here on the southern tip of Africa, we benefited in an extent from these developments, decline in petrol price, although unfortunately a lot of us are not driving around anymore. But that being that, what is your view in terms of where oil price might go in the short, medium term from where we are today?
So I think it's important to note that due to a concerted supply response, that the doomsday worst case scenario was avoided, whereby global storage filled up. And I think that would have been catastrophic for oil. So we have seen a stabilization of oil prices, and I think that is due mainly to a concerted supply response. The most likely scenario, I think, for the remainder of the year is a gradual easing of lockdown measures, which should see continuation of consumption patterns, meaning that post Q2, when we expect significant inventory build, gradual drawdowns of inventories will bring oil markets in balance. I think the global economic growth is expected to be in deep recession this year, meaning that we don't expect a strong rebound in oil. Based on futures markets and analyst expectations, Brent is expected to trade around $35 to $40 per barrel for 2020, with WTI trading $5 lower than that. We expect in 2021 a strong rebound of Brent back to around $50 per barrel, with WTI to trade around $45 per barrel.
Okay. And then maybe just, how do we as investors, make use of an opportunity like this? Obviously, there's always risk and opportunity. These kind of volatility, whether it's in the commodity market, the currency market, there's always some way that we can benefit from that. You sit more on the equity side. So maybe just share with our clients, in regards with this oil theme playing out, what are some of the shares that we will include or exclude from the portfolio to actually benefit from these developments?
So given our cautious view of global economic growth and therefore oil demand, we try and benefit in one of two ways. Firstly, to avoid companies that derive directly or indirectly significant revenue via oil. Two obvious examples here would be Sasol, that obviously is very reliant on oil prices via its Secunda plant, but also chemical prices, which derive their pricing from oil, being an oil derivative. And then secondly, a business like MTN that derives over 50% of earnings from Nigeria. We know the Nigerian economy, how sensitive it is to oil prices. So those would be two examples of companies that we either avoid or are underweight because of our cautious view on oil. And then second, we look for companies that can benefit from lower oil prices, provided they add an element of defensiveness to the portfolio. Two examples here would be SPAR, which is a significant wholesale retail distribution business with oil a key input. And then AngloGold Ashanti, given our positive view on gold and the fact that AngloGold Ashanti operates open cast mines, and hence diesel is a significant cost input into their mining process.
Talking about gold, maybe let's turn to that. In this environment, what we've seen is a search for safe haven assets. So the dollar did very well. US Treasury's done well, at the moment trading at 0.6%. So a lot of that attractiveness is now past. Typically the Swiss franc, the Japanese yen, but gold as a commodity is also a safe bet in very volatile periods. What is your view on it as a currency or a commodity in this kind of environment?
So we think that the macro backdrop for gold is compelling. On this slide, I show central bank balance sheets in trillions of dollars for the G4. So it'd be the US, the ECB, China, and the Bank of Japan. And we can see a significant stimulus response to COVID-19. I think since February, we've added $3.9 trillion through quantitative easing, which is over 6% of global GDP. We think that finds a very, very good backdrop for gold to benefit from. One, through the debasement of fiat currencies as we see lower real growth, and also as a store of value and a portfolio diversification benefit. I think it's not a coincidence that gold is making all-time highs against most global currencies. I think that tells you that the backdrop is very conducive. So almost a hedge against this monetary inflation that we've seen in response to the COVID-19 epidemic.
So gold definitely reacting on the fear in the system as a safe haven. But getting back to our oil discussion, obviously supply and demand is very important for any commodity. So what is the supply and demand dynamics look like for gold specifically? And that will lead us into, the outlook going forward.
If I can just touch on one more point, just in terms of why the central bank stimulus has been important. If you look at gold versus total US debt going back to 1970, there's a very close correlation, around 0.7. So with current US debt of $25 trillion, the expectations for that to rise to $36 trillion by 2030, and therefore gold to do well. So just to bring that into context of why we are so bullish on the commodity. With regards to the demand supply, gold is unique in the sense that it doesn't really have economic linkages. So from a demand supply perspective, it's not a fundamental driver of the gold price. Maybe two points to note on this slide. From a gold demand perspective, around 80% of demand is from jewelry and investment, with the balance going to central banks and technology. Central banks obviously using gold as a reserve. And then on the supply side, as you would expect, mining production accounts for about 70% of gold supply. The interesting thing to note here is since 2015, we've seen an increasingly positive gold price environment. Gold production, though, hasn't really moved. So, and I think that's testament to the fact that gold mines are becoming deeper. We've seen great declines, and the technicality around gold mining has increased significantly. And I think that's bullish for gold. We should see higher investment demand going forward. And the fact that supply is constrained is bullish for gold.
When should one consider including gold in your portfolio? Is now the right time? I think a lot of our clients will ask that question.
I think gold should form a permanent inclusion in any portfolio because of a number of unique attributes that it displays. In the next couple of slides talks to that. The one is that gold maintains its purchasing power. So the slide over here shows in blue and red gold in rand and dollar terms against CPI indexed back to 100s, going back to 1972. Now I think it's clear that gold in rand and dollar terms has maintained its purchasing power. If you contrast that to holding fiat rands and dollars, you would have seen most of your purchasing power being eroded over the past 50 years or so. And then we spoke about the macro environment, the fact that we are in a low and falling real interest rate environment. This shows you month-on-month performance of gold versus commodities, the S&P 500, the Barclays Aggregate Index, which is bonds as well as cash. And you can see that this environment is absolutely perfectly suited for gold to outperform. Third reason is the hedging aspects that gold brings to a portfolio. So in a typical recession, we've seen gold significantly outperform a broad basket of commodities. Again, the S&P 500, bonds and cash. I think that talks to the attributes that it brings to the table as a hedge. And then lastly, if you look at gold, here shown in black here, versus the S&P 500 going back to 1970, I think the important point to note is that gold can and has provided equity-like returns, but with very different performance cycles. And I think the different performance cycles talk to the diversification benefits that gold as it brings to a diversified portfolio.
Yeah, I think this is a very important point. Clients need to appreciate that, yes, gold do have some hedging characteristics, but it remains quite a risky asset. Like you said, it's equity-like returns, and therefore you will also probably consider, your exposure in a portfolio to be in line with that. You won't put like 25% of your portfolio in gold. It should be part of a bigger diversified portfolio. Getting exposure to the commodity. We already spoke about what you do on the equity side. We do include gold companies in our 2020 portfolio. But what other alternatives are available to get exposure to the commodity physically?
So broadly speaking, in addition to the physical, exchange traded funds or gold equity, as you mentioned, would be two examples. And then I think in addition to that, potentially for the more sophisticated investor, use of derivatives, so futures contracts or options would be another way of gaining exposure to gold.
And then finally, we spoke about oil trading or the futures trading at a negative. We're living in a world where anything is possible. So why won't there be a scenario where something like gold, or then the derivatives on the gold, can also go into negative territory?
Yeah, I think if anything, we've seen the opposite play out in gold markets, where the demand for the physical has been so strong that we've seen the physical trade at a premium to the futures market, as well as ETF holdings, as I think investors have scrambled with this COVID-19 global pandemic to get their hands on the physical. So ironically, gold has almost shown the opposite of oil, where oil traders, speculators try to offload gold oil. I think gold investors are trying anything to get their hands on the physical, and therefore I don't think the scenario will play out. If you look at the again, the futures market for gold, it's very stable. We don't see the same steep backwardation and contango curves that we see in oil that tends to go through sort of these boom and bust cycles.
Victor, thank you very much for that and your insights. I think, we are living in very uncertain times, and hopefully to our client base, this gave you a little bit of insight how we will take other parts of the global economy, something like commodities, where it is core to our thinking and our strategy on a daily basis, and how we can look for opportunities, not always the physical commodity, but we can have similar opportunities in something like an equity portfolios. Really appreciate your time, Victor, and to our clients, thank you very much for your time. We will have another update in weeks to follow, and stay safe, stay home, and best luck. Bye.